Joining us for our usual market wrap-up is Mark Wenzel from the Hopkins Group. Good afternoon, Mark.
Hey, Michael. How are you?
Good, thanks. Now, Telstra have released a bit of a scheme, I'm hearing.
Yeah, absolutely. So Telstra have announced that they're releasing a scheme to shareholders for the separation of the infrastructure assets, which covers things like mobile phone towers, the pipes in the ground, and Wi-Fi services that they offer. And at this stage, it's not decided whether they'll spin it off into a separate listed company or sell it in the open market. But the idea is that the assets are considered obviously vital assets. So Telstra must retain 50.1% of those assets. And if any other telecommunications companies want to buy them, say from overseas, they have to be part of the Five Eyes, international conglomerate, that Australia trusts. So they're really, valuable assets for the country, and obviously really valuable assets for Telstra. This part of the company accounted for 12% of Telstra's income, but delivered 26% of Telstra's profits. So from a shareholder's point of view, they can expect to receive $46.5 billion if the assets sell on 28 times earnings, which is obviously a significant windfall for Telstra shareholders.
Great. And the US dollar is making our dollar look a bit shabby.
Yeah, the US dollar continues to go from strength to strength. With the recession fears and the US raising interest rates faster than most of the other countries around, it makes their bonds far more attractive. And in order to buy those bonds, investors have to buy US dollars to buy US dollar bonds, and that's sort of pushing up the price of the US dollar, which is causing problems, particularly from an inflationary point of view in countries that obviously with US dollar denominated debt and US denominated currencies. So that's just making their inflation compound on itself and get more and more higher. So it's like an appreciation spiral. And as the US interest rates increase, they have to buy more US dollars, which again causes further problems with that. From a developed economy point of view, it sort of helps a country like Australia. So obviously with our dollar falling, and it's sort of around the 22.5 cent mark at the moment, it means that our goods and services are cheaper into the global economy, which again should support a stronger economy in Australia, and it means it's more attractive for people to come and holiday in Australia, which again is obviously a really good thing. With part of the emerging markets, it does cause problems potentially with emerging markets. Again, they have to buy oil and those sort of things. They're typically importers of commodities, which are all priced in US dollars, which again sort of creates a further inflation position for them and makes their economies weaker.
Yeah, and the IMF has downgraded Australia's outlook.
Yes. So again, this was sort of earlier this week. So they've downgraded our growth outlook to the lowest level in 20 years outside of the brief period during COVID. So they've reduced the growth rate to 1.9% from 2.2% when they last gave the figures back in July on recession fears, obviously a global slowdown, and particularly, I guess, China, as we know, who has been in lockdown, and certainly the economy there is not performing as strongly as you would expect. So the IMF is forecasting inflation of 4.8% next year, which obviously a good thing, and certainly a lot lower than what sort of headlines have been out there recently. But they have cautioned governments against making policy errors such as the UK government did, which cut taxes, which effectively causes stimulus in the economy when the central banks are trying to rein that stimulus back in to rein in the inflation. And again, they were trying to do the right things, but it was a massive fail for the UK government and caused havoc amongst financial markets and with their currency. This is particularly important because the Australian government's releasing their mini budget next. It's on the 26th of October, and so they'll be on guard not to make the same mistakes. But we are in a far better financial position than the UK government, and with it's been surprising that they've cut the expected maximum debt back by about $500 million on the back of strong commodity prices, full employment, which creates income taxes and obviously strong profits from those commodity companies, which is really positive for Australia. And we'll see lower government debt, and higher commodity prices, but it just sort of shows that there's a lot of negative news that's coming out in the markets at the moment, but there is a real strong underlying narrative, I guess, that's positive, particularly within the Australian economy. And CBA also sort of came out and said that, they're not seeing any signs of slowdown in regards to businesses and or consumer spending at this stage. So maybe it's a bit of a double-edged sword. Maybe it's a good thing in that obviously the economy's strong, but maybe the RBA has to raise interest rates a little bit further than what people expect. But I mean, I certainly wanted to get the message across that things in Australia particularly are not as bad as some of the media outlets like to portray.
And that's why we come to experts like you, Mark, to get the cut through.
Absolutely.
All right, Mark Wenzel from the Hopkins Group. Thanks for our market wrap up, and we'll speak next week.
Appreciate it. Good to see you, Michael.
Likewise.